Chapter 10, E7B, we are taking a look at the revision of depreciation rates. Sometimes the estimates that we make in the beginning need some adjusting along the way. In this situation, we have Green Hospital, and they purchased a special X-ray machine. The machine cost $311,560 and was expected to last 10 years. It also had an estimated residual value of $31,560. However, after 2 years of operation and depreciation charges using the straight line method, it became evident that the X-ray machine would only last a total of 7 years, 3 years less than what was originally estimated. The estimated residual value, however, remains the same. Given this information, we are to determine the new depreciation charge for the third year on the basis of the revised estimated useful life. The first thing we have to do is we have to go ahead and calculate the depreciation for the first 2 years. For the first year and the second year, we don't know that anything is going to change, so we base everything on the 10 years. So first, we're going to calculate our depreciable cost, which is the numerator in the equations we looked at previously. Cost minus residual value is the depreciable cost, which is the amount that can be depreciated. Because keep in mind, we have to subtract out the residual value, the amount we estimate we will get back when we sell it, because that amount is not allowed to be depreciated. Then, for the first year, under the straight line method, we take our depreciable cost and divide it by the 10 years we estimate that it will last. Because keep in mind at this point, when we are actually in year 1, we don't realize that it's going to change. So for year 1, we're going to depreciate $28,000. Additionally, in year 2, we will depreciate $28,000. So at the end of the second year, we have depreciated a total of $56,000. That is the amount that is in our accumulated depreciation account, which again is our contra asset account. So now it is at the end of the second year that we realize that this machine is actually only going to last us a total of 7 years, not 10. So we need to make some adjustments. So the first thing we need to do is, if it's going to last a total of 7 years, we need to subtract out the 2 years that we have already depreciated. So the remaining years that we can depreciate are 5. We then take the remaining depreciable cost, which is our depreciable cost of $280,000, minus the $56,000 we have already depreciated, which gives us $224,000 left to depreciate, and we're now going to spread that over 5 years. So in the third year, we take the $224,000 divided by 5 years, and we come up with $44,800 as our annual depreciation for the third year. And if no other changes occur, that will be the amount that we depreciate for the remainder of the years as well. The journal entry will include a debit to depreciation expense for our X-ray machine and a credit to our contra asset accumulated depreciation for our X-ray machine in the amount of $44,800.